So I want to welcome everyone to Operation Entrepreneur. This is Business Impact Northwest celebration of military connected business owners during National Veterans Small Business Week. We are funded in part through a cooperative agreement with the Small Business Administration to provide these services to you all. So Operation Entrepreneur is an opportunity for Business Impact Northwest to highlight and support the exceptional individuals who have chosen the path of entrepreneurship. I want to express my gratitude to all veterans who have chosen to pursue their dreams of business ownership. Your courage and determination inspire us all. I encourage everyone to support veteran-owned businesses during this week and throughout the year. By doing so, we not only show our appreciation for their service, but also contribute to the growth and prosperity of our nation. So I'd like to introduce myself. I am Melissa Welsh, Business Advisor with the Alaska Veterans Business Outreach Center. We provide business coaching and training for military-connected business owners in Alaska. I am a white female with medium brown hair, hazel eyes, and a blue top with maroon cardigan. I'm in front of a red, white, and blue background. And the other face you will see on the screen is Tracy Willett. She is the Alaska VBOC Director. She is currently teaching one of our Boots to Business classes, so she can't be here on the webinar today. However, I do have Miss Jasmine Garcia here with us. She is the Northwest VBOC Director, and I'd like to give her a moment to introduce herself.
Thank you, Melissa. Welcome in everybody for day 2 of Operation Entrepreneur. I am Northwest VBOC Director, Program Director, and I am a mid-30s Latina woman, dark hair, medium skin, dark eyes. I'm wearing a black turtleneck, and I just wanted to welcome in everybody, and you're in for a treat with Melissa and our guest speaker, Gwen.
Thank you, Jasmine. So here's a quick overview of what you can expect for day 2. In a few minutes, we'll hear from our keynote speaker, Gwen, but I have a few more introductions to do for you first. I want to take this opportunity to give a shout out to the Small Business Administrator, Kelly Leffler. She is a driving force behind the Made in America initiative and has worked hard to reduce barriers that small businesses face. Kelly also is not able to be with us today because of the furloughs currently happening, but we hope that she'll be back to work soon. At this time, I also want to introduce Joe Sky Tucker. He is the CEO of Business Impact Northwest, whose leadership continues to elevate and empower small business across Alaska, Washington, Oregon, Idaho, and beyond. I have a short video to play for you guys.
Hey everyone, my name is Joe Sky Tucker, and I'm the President and CEO of Business Impact Northwest. Welcome to Operation Entrepreneur 2025. We are really excited to have you here. We have some amazing trainings for you as you embark on your entrepreneurial journey or wherever you are in that journey. We are ready to help you and serve you. So we want you to sit back and relax. You're in good hands. Thank you for your service and welcome again to Operation Entrepreneur 2025. Thanks so much.
Appreciate that video from Joe. And now I want to take a moment to get to know today's panelist, Gwen Cole. Gwen serves as a business advisor at Business Impact Northwest, where she provides coaching and training to small business owners, assisting them with loan readiness, financial projections, and cash flow management. Gwen helps clients understand their financials and launch or scale sustainably. With her background in business ownership, consulting, and accounting, she has successfully delivered impactful programs that enhance client engagement and outcomes. So thank you for being here today, Gwen, and I'm going to let you take it away.
Awesome. Thank you, Melissa. All right, I am going to take the slides. I am a white female with like blondish brown hair tied back. I have a blue top on with a black sweater. And today we are going to dive into becoming lender ready. Awesome. Okay, so I'm going to give a brief overview of what lenders look for and what you can do to prepare for a loan application, and then I will take questions at the end, and we can dive into more details based on your questions and the areas that you want to know more at. So, and feel free to drop your questions in the chat too, and I will address them at the end, and Melissa and Jasmine will help me stay on top of all of them. All right, so what do lenders look for? Commonly, this is called the 5 C's of credit. The 5 C's acronym is fairly common. And you'll occasionally see that some of these C words switch out, but this is the basics of what you need to understand in order to get a solid loan application prepared. So the first C is character. This is the track record of repaying your debts. Commonly found through your credit report and your credit score. And yes, it is your personal credit score and credit report. They will also look at the business credit report and credit score, but most look at both, and they emphasize your personal one more because you are the human behind the business, and until your business is super large and well established and making multiples of millions, they want a person behind it. So character is your credit score. The next C is your capacity, so the ability to repay the loan from operational revenue. This can, depending on how well established your business is, this can be just business revenues or operations, or it can also be your personal capacity. So do you have another source of income, or do you have a household income that can, if the business doesn't end up working out, do you have the personal resources to continue to repay the loan? That is a secondary factor, right? The third C is capital. So the money invested by the business owner or the management team. This can also be kind of like, you can think of it as a down payment, but it doesn't have to be cash in the bank. It has to be money and resources that you've committed to the business, or you have money generated from the business that you're putting back into the business. So you have to show that you are committing your own resources and the business resources to making this business successful. You're not totally relying on outside funding like from a lender. So that's what the capital is getting towards. The fourth C is collateral. So most business loans, the lenders will look for you to pledge an asset against to secure the loan. So this is telling the lender that if the worst case happens and the business cannot repay the loan, there's an option to turn over the collateral that's pledged against it, so the lender can recoup the loan amount of money. There are options if you don't have collateral. There are options, and in future slides, I'll go into a little bit more about that. And this is also a common question. So hold on to those thoughts, put them in the chat if you want, and I'll address them in future slides. The fifth C, which is often the one you'll see might be switched out for something different, but what we look at is conditions. These are the conditions of the purpose of the loan, what you'll be using the money for, as well as industry trends and market trends. And the lender will look at how of these impact or possibly could impact loan repayment. Some of these are in your control that you can mitigate, and some of them, like your industry conditions, are going to be outside your control. But if you're aware of them, you can address them with the loan provider and, have a plan B or a plan C if the industry pauses, like if there's a government shutdown or tariffs and trade are affecting your industry and there's a lot of uncertainty. Lenders don't like uncertainty. So if there's a lot of uncertainty in your industry, have a plan to address that, and that can help increase your chances of getting approved for the loan. Those are the basic factors. So as a small business owner, you decided that you think you need a loan. These are the things to get clear of before you even start an application or start the research process. So get very clear on why you want the loan, because debt is expensive. So what will you use the money for, and how will this increase your revenues? Be very specific when you ask, right? A lender wants you to tell them how much you want. If you approach a lender and you're like, well, how much will you give me? That's a flag for a lender because that shows you haven't done your research, right? You can have multiple levels, like, I want $100,000. This is how I will use it through XYZ. But there's also an option where I can make it work with $70,000. So you can have those differences, but you need to understand what you need and what the original loan ask is for, and then any negotiating points that work for you or don't work for you. And then the next thing to get clear on is your timeline, right? So loan process can vary for how much that it takes to get approved for the loan and the money dispersed. So be very clear on what you are able to do. What is your runway in the business? It is easier to get a loan when you have money. So before you hit that crisis point or before you're like, I need this to happen yesterday, the more time you can, more time in advance you can give yourself, the better off you'll be and the more relaxed a lender will be about it. And then the timeline for use of money as well. So depending on how you're using the loan funds, like if you're purchasing a piece of equipment or a vehicle, like that money's not ever going to touch your bank account. It's going to go straight to paying the vendor for the piece of equipment or the vehicle. And so your operational revenues need to be able to repay the loan from the very first month, right? If you're using the loan funds for something like working capital or 3 months of overhead expenses, then you'll have money sitting in the bank, right? So you have some time to generate revenue to continue to make the loan payments. So understanding that operational timeline and use of funds in your business and how long it can possibly take to get the loan is super important just to have clear. And then the last point here is kind of like overall goals and expected outcomes of the loan, because a lender does not want to lend money to a business that is relying on debt to pay expenses. So when you go after debt in order to get money for some purpose, and large chunks of money in a loan can be very useful in a business, but you need to understand how that's going to scale your business, how it's going to elevate your revenues so that you are using revenues to cover expenses to repay debt and you're not relying on that debt. So having that broad picture, your goals and expected outcomes of what you'll use the loan for is super helpful because you can explain it to a lender and help them to understand your business and why you need this loan. And so the next step then is to start researching. So there's all different types of business loans that are out there. And depending on why you're seeking a loan, some are going to be better options for you and some aren't going to be relevant to your business at all. So figure out what type of loan is the type of loan you need for what you're going to use the money for, and then figure out who offers that loan, because not all lenders have the same types of loans or offer all the loans. So these are some of the most common small business loans. Small business loans often can cover working capital. So there's a little bit more flexibility in that. Unlike like some of the bottom, the equipment financing, and that also has the opportunity to not go through, a bank or traditional lender. You can, if you're purchasing equipment, the supplier you're purchasing from might offer a financing option, right? So that is still a debt. It is a small business loan, but it is specific for equipment financing. Some other specifics there are like the real estate financing or the franchise loans. Those are very specific uses, right? So it might be perfect for your business, or you might need the broader loan, like a small business loan or a commercial loan. SBA loans are pretty common. Most people have heard of them, but the process is complicated, right? So SBA is kind of a backup for small business lenders. So banks, credit unions, CDFIs, like Business Impact Northwest is a nonprofit community fund, a CDFI. We do SBA loans in addition to our other small business loans. And so you apply through that lender, but then the SBA has more paperwork and has the ultimate sign off on the SBA loan. They often take longer than other loans. So be prepared if you're like, I want an SBA loan. And there are some really good reasons to go after an SBA loan. But if that's the one you decide is for you, give yourself a longer timeline, because it's a lot of paperwork and it can be a slow process. The other types on here, the merchant cash advance. This is a very specialized loan through your merchant processor. So different merchant processors will offer different cash advances. And be careful if you go into them. They can be super easy to get, because the provider, if it's like Square, Stripe, Payroll, whoever your merchant provider is, they will offer you money, and often the repayment terms are based on your daily or weekly sales, and so they'll automatically just pull it out. So you have to make sure that your cash flow can support that, because if you have 20% of your daily sales going to the repayment of this debt, that only leaves you a certain amount of money to cover all of the other expenses. So they're often pretty fast to get, but you'd have to understand your cash flow and be aware of that repayment structure to make sure you don't get into, trouble in a crisis mode where you're relying on them for cash. So just be careful with them. They're not always, a lot of people think that all MCAs, merchant cash advances, are predatory. They're not all predatory. Some of them have interest rates pretty in line with other small business loan interest rates, but it's that daily percentage of sales that can get businesses into trouble. So just be careful, be aware, understand the terms, and I'll go into more of like what terms you should be looking at in a different slide. The last one is disaster loans on here. So these are really hard to plan for. You're kind of, if a disaster hits, you're in it, right? How do you deal with it? And so different lenders will have disaster loans to help you rebuild or repair or recover from that. And it's paperwork. So some of the stuff in the next couple slides I'll show are like how to prepare for a loan application. You can still apply that and get organized and be aware of what your credit score is, so that if disaster strikes and you need a disaster loan to help you rebuild, it's faster to get because you have everything organized for the application. The last thing on that too, your time in business is important for these loans. So startups in the lending world is any business under 2 years old, because you don't have that track record of revenues. So you have to have been generating revenues for 2 years to actually build and understand what your expected revenues are, what your expected expenses are. And so when you don't have that 2 years of financial history, a lender will consider you a startup, and they'll make a decision more on the projections, what you estimate to happen in the future with your revenues and your expenses. And I'll go into that a little bit more. Not all lenders lend to startups. So if you are a business, you have a business that's less than 2 years old, ask those questions. Like, I've only been in business for 2 years. Will you do a loan for me? Or do you need me to be in business for a couple more years before that's even a conversation, right? And so if you need a loan now, you're not going to be able to get a loan at all places if they don't do that startup loan. So just be aware of that. Okay, so steps to prepare. You've gone through all of this. You know you need a loan. You know what type of loan you want, or you have a couple options, and you know what lenders offer those loans, and that your time in business qualifies you, right? So the first thing, because it takes a long time, is going to be focused on your credit score. So if your credit score isn't where you want it to be, start today. Even if you're like, next summer or in a couple years, I think I'll need a loan, or I'll want a loan to expand. Be aware of what your credit score is and take steps to improve it. Annualcreditreport.com is a great place to get your report. The credit report for the 3 bureaus, TransUnion, Experian, and Equifax, that's the data that goes into the algorithm that pops out your credit score. A lot of lenders now aren't, especially credit unions and CDFIs, don't have a minimum credit score. So even if your credit score isn't stellar, you can still apply. What they do is, the higher your score, the better terms you'll get. So the lower the interest rates, and factors that bring your score down are also factors that a lender can be like, this loan is too risky. We can't underwrite this. So that comes back to that character C. Do you repay your debts on time? If you aren't making on-time payments, that is one of the quickest ways that your credit score can drop. And a lender will look at that and look, they don't pay their other debts. What's the reassurance that they're going to pay this debt? So make on-time payments, keep your score higher. If something happens, right, because sometimes life happens and you can't make payments, or you have unexpected bills, you have medical expenses, all this stuff that can drop your score. It can drop overnight super quickly, and it takes a long time to build up. So if you can show like, hey, this happened, here's what happened, but I've been making on-time payments since then, like a lot of times a lender will be like, all right, like this is good. Like you understand what happened and these are the steps you're taking. And that can help, right? So even if your score is lower and something happened in the past, but you have like 12 or more months of trying to fix it, a lot of lenders will be okay with that. And one of the resources Business Impact Northwest has is certified credit counselors. So I'm one of the certified credit counselors, and there are a few others working on it that, we're always happy to just have a conversation about what goes into your credit score and how do you improve it, or how do you keep it higher or maintain it higher. And so we can help with that. Even if you're like, I'm not ready for a loan, but I want to work on this now. We're always happy to have those conversations. And a lot of times a lender will say, oh, like you met with a credit counselor, like, okay, like you're doing the steps to get your score higher or to maintain it. So they like that. So those are some things you can do to prepare for your credit score. The next thing you can do to prepare, also far in advance, is keep organized financial statements. So this is the primary resource that lenders look at to determine if they can do a loan for you or not. So if your financial data isn't organized, you don't have financial statements, you don't have that track record, like take steps to figure out how to fix that stuff to put you in a good position when you are ready to apply for a loan. So established businesses, a lot of times lenders will look for 2 to 3 years of historical financials, usually your profit and loss, commonly called a P&L, and then your current year-to-date P&L and balance sheet. And the difference, the profit and loss, is the record of revenues, operational revenues, and operational expenses. The balance sheet shows more than just operational. So the balance sheet will show assets, equipment that the business owns, as well as debts that are on there that aren't going to show up on the P&L. Sometimes lenders will want to see 2 to 3 years prior of the balance sheet as well, but not always. Sometimes it's just the current year to date to get that snapshot. So start there, and then if they ask for further information, be prepared to turn it in to give them those reports. A lender will also want 2 to 3 years of business tax returns and personal tax returns. And this comes back to, yes, it is a business loan, but you as the business owner have to guarantee it. So they want to see what your personal tax returns show about income, household resources, things like that. Just in case, the business can't do it, can you make those payments? So it's reassurance. It's helping to mitigate those risks for the lender. And then for startups, if you don't have 2 to 3 years of historicals, the lender will want to see what you do have for historicals. So if you've been generating revenue for a year, they'll want to see that year. And then they'll also ask for financial projections. Usually what financial projections means is the next 12 months of detail. So all of your revenue streams, or the largest categories, our lending team asks for up to 7. So if you have more than 7 revenue streams, clump them together and show what those sales for each of the next 12 months are expected to be. And then also expenses. So direct costs, cost of goods, as well as overhead expenses for the next 12 months. And this should be when the money comes in and when the money goes out of your business. So if you pay insurance every 6 months, put it every 6 months. Don't divide that up evenly. Show when it leaves your bank account. And then they'll want the next, so year 2 and 3 annual summary. So they don't need monthly detail for the next couple of years, but they do want an annual expected revenue and expenses. And then you'll need a business plan to show the assumptions behind these, because you're looking at a crystal ball and you're saying, this is what my sales are going to be, this is what my expenses are going to be. And you need to back up how you get those numbers, right? So you're showing your assumptions in your business plan, your financial assumptions in your business plan. And then sometimes established businesses will also be asked to submit financial projections. Usually this is like if you're significantly changing the business model, like you're going from a restaurant to a food cart, or a food cart to a restaurant, food truck to a restaurant, like it changes, right? Because you're no longer going to your customers, you're making your customers come to you. And so they'll want to see how you plan that change. And so they'll want a business plan and projections for that. And sometimes too, if you're opening like a second location that's in a, significantly different, they'll want to see what your plan is for that location and what your expected financials are. So sometimes established businesses will also be asked for financial projections, but startups always are, so be prepared for that. And then the last thing is that if a loan, based on all of these financial statements, if a loan officer or a small business banker thinks that the loan is a possibility and they're going to move it forward into their underwriting team, they'll ask for a personal financial statement. And it's a template, it's a standard form. You can drop it into Google search or whatever search engine you use and find it, right? It is an SBA form, so it is always required if you're going for that SBA loan. But sometimes lenders will ask for it even if you're not going after the SBA loan, because it's basically a balance sheet for your personal assets, right? So it shows everything you own, all the debts that you owe personally, because you are personally guaranteeing the loan as the human behind the business. And if you have multiple business owners, like if you're a partnership or you have multiple members in an LLC, anybody who owns 20% or more of the business has to be a part of this loan application. So that means your credit score is going to be checked. You each have to submit the personal financial statement if it's asked for, and you have to be a part of the conversation with the loan officer. So keep that in mind too. And so those financial statements, organized financials, credit score are like the biggest things that take time to prepare if you don't already have them prepared. So start them now. And they're also good just to be on top of, even if you're not going after a loan. So smart business decisions, right? The next slide here is tips on getting approved. So all those documents, have them well prepared. Be clear in your loan ask amount and use of loan funds. You can think of a loan application to a lender as like your resume when you're going to apply for a job, right? You need your business to look good on paper. And then when you get it through the door, a loan officer, a small business banker is looking at it, you need to be able to talk about it. So you should understand what your financials, what your numbers tell about your business, the story they tell about the business, and be able to explain how you got there if you're showing financial projections. So show your research, show your assumptions, and be realistic about your growth, right? Most startups right out the gate don't make $1 million. So show that growth and a reasonable trajectory. For a startup, it could be exponential because you have that hustle. For an established business, if it's business as usual, your growth isn't going to be that big. If you're buying a piece of equipment for increasing capacity of making a product, then you might have extra sales in that revenue stream, whatever that equipment is used for, right? So you should match whatever the story is and what you are using the loan funds for and how that's going to increase your revenues. It should show the same in your financials. And if you're asked to do projections, it should match there and with the business plan, right? And then go with the right lender. So if you're always seeking a loan from a lender who doesn't offer the loan that is best for your business, it's not going to work. So put the time in for that research to find out what loan works best for your business, and then what lenders do those loans. And if you're a startup, make sure they lend to a startup. If you pass that 2-year mark, it might be worth the conversation. Like if you're right at that 2-year mark, worth the conversation just to ask them and be like, hey, like I have 2 years, but I don't have more than 2 years. And they might, be like, well, we want you to have another year under your belt. So just, start that conversation and ask. And then make sure that you're demonstrating your relevant experience and passion for your business, especially as a startup. A lot of the financial documents, can show your traction in your history. Like, yeah, I'm profitable. I know what I'm doing. If you don't have that financial track record, you're relying on your business plan to show that you are the one to make this successful. So you have the industry experience, or you have experience to manage the employees that you need in order to pull off the business. So you really need to prove that to a lender. And then your credit score and your track record of repaying debts is also super important. So make sure you have that track record and your credit score reflects it. And then the last point here is having an established relationship with a lender can be helpful. So when I talk to clients about looking for a loan, I always say talk to where you already have your business bank account, because they know how you manage money, right? If you're overdrawing your account every other month, like they already know that. Like, here's the things to work on, and then we can talk about a loan, right? If you're solid with your revenues, you keep a retained earnings in your business bank account, and that even if you're smaller or you've only been in business for a couple of years, they might be able to do the loan. And because they know you, they'll offer you good terms, right? Same with if you've gotten a loan with somebody before, even if it's not where you have your business bank account, and that relationship went well, like you paid it on time, you paid it off, it can be easier to get a second loan from that same lender because you have that pre-existing relationship, right? And so with that in mind too, if you know that you're going to have a large capital need in the future and you're going to ask for a very big loan, you might want to start that relationship now and say, well, like, I'm going to go for a small loan. Like, we're going to do a $10,000, $20,000 loan here just to establish that relationship. Because I want in the future, like a year or 2 years down the road, I know I'm going to have a bigger ask. And so I want to build that relationship on positivity now so that that larger loan has a higher chance, right? And so I have a couple more slides. So this slide is coming back to those 5 C's in that first slide, just to remind you of them. And it's also phrasing them a little bit differently if it helps to remember a different word, right? So character was the first one. That's your credit score. Collateral is collateral. Cash flow is often something that's talked about. That is both your capacity and your capital available, right? What are you putting into the business? The debt load is something that lenders look at as well, your debt to income ratio. So if you already have a lot of debt, that is a red flag for lenders, because it's showing that you're relying on debt to pay your expenses rather than your revenues and your income from the business. And they want to see that the business is sustainable. So that debt load comes back to that capacity as well as the cash flow part. Then industry is your conditions, what's going on in the world. And how will that affect your business? And then the last point that lenders look for, which is not a 5C, but it's still important, is that time in business. So if you've been in business for a year and a half, it can feel like you are established, like you've been in it, you're almost at that 2-year mark. You're like, I'm not a startup, like I know what I'm doing. But in the lending world, you will still be considered a startup. So keep that in mind. And then the last slide here is just another way to think about this too with your business plan and your financials. So everybody has to turn in the financials, whether it's historical or projections. And if you're an established business, the lender is going to look for what equity you have in the business, the cash. AR is also accounts receivable. So if you're waiting for your clients to pay you, that's what accounts receivable is. That's money that's coming into your business. So if there's a big gap, right? I know a lot of my clients who work with health insurance and the insurance pays them, like there can be a long waiting time before the insurance pays out on them. And so sometimes you're seeking a loan to cover that gap, right? So that AR is an asset, that accounts receivable is an asset that you can get a loan against. What your profitability is, value of collateral, and your history of repayment. All of those things are in your financial documents that you submit as a part of your loan application. And then if you have to submit the business plan, you are showing that it's a viable model, it makes sense, you've done your research, you have the experience, or you're hiring the management team with the experience needed to make this business successful, sustainable, and that it has growth potential, at least to cover all of its expenses, and it has staying power, right? If you're established, all of those things will show up in your financials, because if you don't have a viable business model, you're not going to stay in business. So a lender can determine those things from your financials, which is why they don't always ask for a business plan from established businesses. But if you don't have that track record, then they need to see it in the business plan. And that's it. That's the basic overview of all the information. You can always reach out to me. My email is here. I'm happy to have a conversation about, how do you get loan ready? How do you do that loan preparation? Your coach at Business Impact Northwest or advisor, mentor elsewhere can be a great resource too, and with experience.
All right, welcome back, everybody. We have a couple more things that we wanted Gwen to jump into. There's some common questions that regularly come up, and so I'm going to flip through a couple more slides here for Gwen, and she's going to address a couple things and then answer some more questions for us. So, ready, Gwen?
Yes.
Wonderful. Okay. So, go ahead and tell us a little bit about different loan myths. These are things that I often see coming up when I'm coaching clients. So I'd love to hear your take on it.
Yeah, definitely. I also see these pretty often. A big thing with the small business loan application process is just unknowns, right? And so it's scary to get into something that we don't know, or we want to be prepared for. Perfectionists especially, like everything set up and ahead of time. And if you don't understand the process or know what to prepare for, that can be really challenging. So that's a part of my job, is just provide transparency around it. And these myths are pretty often I have clients coming to me like asking questions about this. So the first one is that obtaining a small business loan is a long and frustrating process. And that is not true. Sometimes it can be true, but it is not always that way. Some of it depends on what lender you go to. Business Impact Northwest has on the longer side timeline. So there are places you can go and find a faster loan. The trade-off often with a faster loan is you don't have as much negotiating power with the rates, or there's no collateral part of it, as the paperwork with the collateral takes longer. And if there's no collateral, sometimes your interest rate will be higher, or it's predatory loans are super fast. They make it really easy to get the money, but then you're paying like a 50% interest rate, which is insane.
And I have a question regarding that too.
Yeah.
So, you mentioned Business Impact having a little bit longer of a timeline. What are the benefits that come along with that, such as, technical assistance, for instance,
Yep.
versus a predatory type loan? And what does that timeline kind of look like so that we understand, whether that is, are you looking at 90 days? Not, sometimes I ask, hey, can I get a loan and have the money next week? Probably not, but can you dive a little deeper into that?
Yeah, so Business Impact Northwest process averages 6 weeks, so a month and a half. It does go faster the more prepared you are. So if you have all of the paperwork in order, your numbers make sense, it's a very clear loan ask, it can go faster. Usually not very much under a month's time though. So you're still looking at 3 or 4 weeks. And then that's loan approval, and then it takes time to disperse the funds. And a lot of that is just back and forth with paperwork, right? There's all sorts of paperwork, and you need signatures. Some of them need ink signatures. And so you have to print it, ink it, get it notarized, send it back in, drop it off in person. And so it's just time, right? And some of it is on the client side of it, right? How long does it take you to get the paperwork that's being asked for, to line up those meetings? We've had clients who like get a loan approved and then head off out of country for vacation, and the loan time's out, right? The loan, it's not dispersed without that paperwork signed. And if you're not available to sign that paperwork, then it doesn't happen. So make sure you're around and present and able to get the paperwork back to the loan officer. And then we offer a lot of coaching and technical assistance. And our clients, this may be the first loan that they're getting. And so that also extends that timeline for our average, right, across all the clients that we deal with. There are loans that move faster. So as part of prep work and understanding that timeline, this is also why it's easier to get money in advance, right, before you actually need it, because you're giving yourself that time and you're not hitting that crisis. Lenders that have and a lot of our loans are for working capital, right? So there's more research that has to go in, due diligence that a loan officer has to do to make sure that the funds are going to be used appropriately and in accordance with our bylaws and guidelines and everything that our board says it has to be. For loans that are, very straightforward, like their vehicle loans or their equipment loans, the paperwork is more standard, right? Like this is what the money's for. This is the vendor that sells it. The money goes to the supplier, the vendor, and the equipment comes to the business owner. And the equipment is used as collateral, so the title changes hands, right? That can happen faster. And lenders who do those types of loans all the time, they have their process down, right? So it can happen in a couple of days. So talk to the lender, like look at lenders who offer the loan that you're interested in, and then reach out and talk to them and ask them questions. Because that can help identify the timeline on the lender side so that you have information for your own business timeline. And then interest rates too. So that the things you should look at when you're determining what loan you want in your business, the term is how long you have to repay the loan. So oftentimes like smaller loans, working capital loans, like our loans are usually 5 years. Sometimes they're 7 years, but I think we start at 5 years. We don't really go below 5 years, but there are lenders that will do 3 years. And so the longer it takes to repay the loan, the lower the monthly payment you have to make. And so that can improve your cash flow. So you're looking at that term, the length of time, and also the interest rate. And sometimes the faster the loan has to be repaid, the lower the interest rate, but your monthly payment can still be high. And so you really need to know what your business is capable of. And so you might have an 18-month term with a lower interest rate, but your monthly repayment is still like $1,000. Whereas if you go to a lender that has, a little bit of a higher interest rate, but can give you a 5-year term, your monthly payment might be like $500, which is way better for your cash flow. And so you're balancing both of those things. And then also, if you can pay it off early, like, commit to a lower monthly payment, but then you can always make additional payments. Just check with the lender. Some lenders do have early repayment fees. Business Impact Northwest does not. So like pay it off early. We love it when people pay it off early. But that is something to be aware of, and just double check if you're planning on it. Yeah. And I think that got all your questions.
Yeah, wonderful. And I would also be wondering about needing a large down payment. So we see that's a myth. Can you explain that a little bit further to us?
Yeah, the standard, it's called a down payment, and I put that in quotes, is 10%. 10 to 20% is usually what lenders look for. It's not your typical down payment. Like when you go to buy a vehicle or a house, you need to have that money in the bank account to contribute. When a small business lender is talking about a down payment, if you have the cash on hand to contribute to the project ask that your loan amount is funding, awesome. But a lot of lenders look at it as, have you committed at least 10% of the loan ask into the business, right? So when our lending team looks at this, they're like, okay, you've paid expenses. You put a whole bunch of money in that was at least 10% when you opened the business bank account, right? It's at any point in the business's existence. And this is just showing, like, you know, the business owner is committing their resources. They have that skin in the game to make the business happen, right? They are risking their own resources. They're not just risking somebody else's resources. So that's what they look for with a down payment. It doesn't actually have to be cash in a bank account. It can be already spent, but it should be committed to the business.
Wonderful. What if I had for my business, what if I had a vehicle that, you know, a really nice truck of sorts that cost a lot of money? Is that also, you know, can that go as part of that, or do they look at that separately?
It depends, is going to be the shortest answer. So vehicles as a business asset, it should be in the business name. If it's a personal asset, it's probably not going to count as a down payment because it's not in the business, right? It's still in the person's name. But it could be used as collateral. And so the things that are preferred collateral are things that retain value, which is usually just real estate. So if there's real estate to be pledged for collateral, that's the lender's favorite almost always. New vehicles and equipment are next because there's usually a pretty standard process to resell them if needed, and they're usually worth more. Inventory, some places accept it as collateral, a lot of places won't. And the way you can think about all of these things is like as business assets, personal assets that can be pledged as collateral. What is it going to be like, you know, if the worst case happens and the business closes or it can't make the debt payments and you're turning over the collateral to this bank, to this credit union, to the lender? What are they going to do with it, right? They have to resell it in order to recoup that money from the loan. They don't know how to sell your inventory. They're not going to get as much money as you could selling that inventory. So they don't like to accept inventory as collateral. Whereas, you know, real estate with a house, that's a pretty straightforward market to resell it. Again, they're not going to get as much as you could, right? Because they're going to sell it fast, and so it's going to be a discounted rate because they just want to recoup the amount of the loan. And so looking at all of those types of collateral that's available, if you have that 1-to-1 ratio for the loan amount, that's awesome. If you don't have that 1-to-1 ratio, then that's where a lot of people look at SBA because the SBA helps to secure the loans for the lender to reduce that risk. So if you have a collateral shortfall, often you'll be in an SBA loan program. Not always, but often. And the other thing with collateral shortfalls too is if the loan amount is smaller, then there are places that even are like, you know, we'll do a loan under $30,000, no collateral required, right? Merchant cash advances almost always don't require collateral. And so because they're basing it off of your revenues. They can see how much sales you process every day. And they're like, yeah, we can extend you this cash because we know you can repay it. But the loan amounts are going to be smaller. The higher your loan ask, the more important it is for you to have that 1-to-1 ratio of collateral. And I answered more questions than just that one question.
Love it. No, this is all very wonderful and useful. We have another one in the comments, so I'll read this to you. So it's a two-part question. Is there a starting point as far as credit score is concerned to being deemed pre-eligible for a loan? And do lenders report to business credit bureaus?
Yeah, so I'm gonna answer the second one first, because it's a shorter answer. So yes, debt is typically reported to credit bureaus. So business debt will build your business credits. As you're personally guaranteeing the business loan, though, it will often show up on your personal credit report as well. So it shows up in two places. All lenders report to the credit bureaus. The first part of your question, is there a starting point for credit score? Depends on the lender. So some lenders have a minimum credit score, some lenders don't. So do your research with the lender. For Business Impact Northwest, we have preferences. So if you're a startup business under 2 years old, they really want your credit score to be over 650. If it's under 650, it's not an immediate no. It's a what happened. Tell us the story and tell us what you're doing to improve it. For established businesses, their preference is over 600. But it's the same thing. If it's under 600, they want to know the story and they want to know what you're doing to improve it. And it comes back to those factors too, right? So even if it's not an immediate no, if your score plummeted because you're not making debt payments, then the lender is going to be really hesitant to do a loan. And it's not entirely based off your credit score, but it's based off the factors that go into that character aspect of the 5 C's, which, you know, the credit score informs that, the credit report informs that. So yeah. But if you're taking steps to improve it, you know, even if it is like right at 650 or 600 and your last 12 months on your credit report show on-time payments, you're taking the right steps to deal with collections, to doing everything you can to improve that credit score, then it's possible they will still do the loan, as long as all the other factors are really strong, right? You have a solid business, the cash flow and the capacity show that you'll have no problems repaying the debt repayment. You have enough collateral. So if those factors are really strong, then a lower credit score, they can work around.
Wonderful. Thank you. One more from this slide. So, we see this point, this myth here about getting a loan for a startup is nearly impossible. And I don't know if others have heard the phrase, you can have all the money from a bank as long as you don't need it, right? You know, I feel like that's a very common myth that is out there. So do you want to talk a little bit about that?
Yeah. And I've had clients come to me and like, no one will give me a loan, and they didn't know why. And the first question I asked was like, well, how long have you been in business? A year and a half. That's why, right? And it can be a super frustrating process if banks and credit unions and everywhere you're going for a loan won't tell you that. Like, oh, you just need a little bit more time in business. You need that track record. But a lot of bigger banks, especially, like they don't take the time to actually sit down with a small business owner and explain the steps and the processes. So just having that knowledge in your head, right? Like anything under 2 years old in a business is considered a startup, and a lot of places won't lend to startups. And so if you're applying to places that do lend to startups, as long as you're meeting the criteria and you have organized financials and the loan is a good idea, like you can repay it, your paperwork, your financials, your business plan show how and why you will be able to repay it, you should be able to find a loan.
Wonderful, thank you. And as Gwen has already mentioned, you know, she's very into the transparency of it, obviously very knowledgeable. So she left her contact information for anybody who, you know, is having difficulties there and needs some explanation as to why. Additionally, if you go to sba.gov/lendermatch, they try to assist you with finding somebody who is most likely to finance your project as well.
Yeah, you'll get a whole long list of lenders who are potential.
Okay, so we in this slide here, we have a few reasons for credit denial. So do you want to tell us a little bit about this?
Yeah. So these stats are from a couple years ago, from surveys that went out. And keep in mind that these are all different sizes of businesses, right? The most common reason for credit denial, and credit is from a lender perspective, they're extending you credit. So this is also reasons for a loan denial from the small business owner perspective. That top one there is too much debt. So you already have debt in your business and your operational revenues aren't enough to cover it. And so they don't want to give you more debt until you pay off some of that debt. And there is, the potential path forward to refinance old debt, high interest debt, accounts payable. But there are restrictions in loans, like if you have a collateral shortfall, you don't have enough collateral to cover the loan you need to refinance debt, the SBA is the best place for you for finding a loan with that security for the lender that they will recoup their money. However, an SBA loan cannot be used to refinance other federal funds. So if you are trying to refinance an older SBA loan, it's not going to work. And the SBA also won't refinance like merchant cash advances and things like that. So if you're in that hole where you got pretty quick money, but your cash flow isn't supporting, 20% of your sales going to the repaying of the debt, an SBA loan isn't going to work to refinance. So you're going to be in with a bank or credit union or a CDFI loan product that is not SBA. And so it limits your pool, right? So options, be aware of what you qualify for, what you don't qualify for. And then that next biggest reason for loan denial is that low credit score. So a lot of bigger banks do still have minimums. They're a machine, a lending machine, a depository, so they open accounts, and they want to make money off of what they do. And so they do still have credit score minimums. And if you don't have the right high enough credit score, they're not even going to look at your loan application. The same goes to, so if it's the same amount of paperwork no matter the size of the loan. So if you're looking for $5 million or $5,000, it's pretty much the same amount of paperwork. And so bigger banks don't always want to do those smaller loans because they don't make as much money off of them. And so sometimes it goes into the black hole, right? And you don't ever hear back from them and you don't ever hear back why. So approaching a credit union or a CDFI can be a better option for you if you have a smaller loan need.
Thank you for that. I wanted to quickly ask a question about that insufficient collateral. So that's kind of the next biggest one at 33%. So let's say that I don't have enough collateral for my business, but I have a rich uncle who has some collateral. Can they pledge that on my behalf?
Yes,
Oh.
you can, if you don't have the collateral, and a collateral that you can pledge against a small business loan can be owned by the business or can be owned by an individual as, first choice business owner. But if you don't have it, then if you have a family member willing to pledge it on your behalf, yes, that is acceptable. From a business advisor standpoint, make sure you're very open, communicative, build a contract with that family member, right? Because if you don't do what you said you're going to do in the business closes, your uncle loses their house because you didn't do this loan, there's going to be all sorts of problems with that.
Thanksgiving dinner is going to be awkward, right?
Right. Yes. Be careful, but yes, it is absolutely possible.
We have another question in the chat. So the question here is, does it not look good to a lender if you use grant money to pay off a loan? Can loans be legally paid by grants? And then the other part here is, are subprime APRs seen in small business loans?
Yeah, so two very different questions.
Very different, yeah.
I'm going to address grants first.
Yeah.
Grants are a different animal. So if you are a nonprofit going for grants, not every small business lender will lend to a nonprofit because your your revenues, and you like it's a board. There's no personal guarantee behind a nonprofit, and so it gets complicated. Some lenders do lend to nonprofits, and it's usually pretty clear on their website because nonprofits do need to borrow money sometimes. And so like be aware from that standpoint where you're looking for a loan. If you are a for-profit going after grants, you have to well, even nonprofits, but you have to comply with the grant, right? So some grants have very specific allowed uses of money that may or may not include repaying a debt, right? The more common piece that I see, especially in the agricultural world, there are grants for like farms, animal farms, plant farms, food farms, right? That reimburse. And so you might get a large grant for this project, but then you have to extend the money yourself and submit the receipts. And 3 months down the road, you get that money back. And you can apply for a loan to cover that gap. So you're not depleting your savings to front the capital for that project before you get reimbursed from the grant. That's the more common place that I see. So instead of the grant repaying the loan, it's the loan covering the gap. And then you do use the grant funds to repay the loan, but that's, upfront from the beginning when you apply for the loan.
Wonderful.
And then the second question there, subprime APRs. So this is the interest rates. It depends where you go. So prime plus is the most common interest rate. So subprime interest rates, some places have them, some places don't. For Business Impact Northwest, we don't do prime loans at all, prime plus, subprime. Our interest rates are locked in based on where we get the pool of money. Which sometimes means we are above that. Sometimes it means we are below prime, right? It's kind of a delayed action depending on where we got the money. And sometimes we're able to get really cool resources for loans. Like in the past, we've had veteran and military specific small business loans that were way below prime. And we get that money from that partner to lend out. Once the pool of money is gone, it's gone. So, there's usually a project point from our partner, like, okay, we have this money for 3 years and then that pool of money goes away. Or we lend it all out and it comes back to that partner, right? And it's gone. So they don't always exist, but sometimes they do. So this is where you reach out to the lender and say, hey, do you have anything specifically for veterans? And we'll be like, yes, actually we do, or not at this time, right? So that's how you find some of those subprime rates through CDFIs and credit unions. Not always at the bigger banks, but yeah.
Awesome. Thank you. Okay, so tell us a little bit about paying off our debts, because we want a nice debt to income ratio, right? Before we're applying for loans and such. I feel like you've covered that topic pretty well.
Yeah. If you're relying on debt to cover operational expenses, you're gonna eventually hit the end of that runway and you're gonna run out of money. So how do you leverage that debt to increase your revenue? And this is where it becomes very strategic, because debt is expensive. So you have to be strategic about taking it on. And I work with my clients on this all the time. And a part of it is, how do you pay off the debt? So if you're going to get a loan and go into debt, have a plan to pay it off. This is small business loans or personal loans, right? Very, very top point is to understand the terms. So know what you're getting into, know what you're expected to repay, when and how much, what the interest rate is, if there's early payment, penalty fees, anything like that. So you want to make sure that you understand all of those terms before you sign the paperwork to get the loan. And then if you're having trouble making that monthly payment or weekly or daily payment, whatever you agreed to, reach out, seek help, communicate that. Especially like here at Business Impact Northwest, we love clients who are proactive about that communication. And if you know you're going to struggle to make that monthly payment, then there are options, because we would much rather you succeed as a business owner, and we can do interest only for a couple months, things like that, to help you, rather than you miss a payment, ghost us, and or go out of business, right? Because your cash flow can't keep up with your expenses. So we'll work with you as much as we are able to help you stay in business, and get through whatever that slow cash crunch is, right? If you're having trouble. So communicate that. And I know a lot of other places do that too, especially the CDFIs and the credit unions, and every lender that is very community centered. Like, we all want to help businesses. That's why we do what we do. So if you can communicate, reach out, be proactive about that, explain what's going on. In here at Business Impact Northwest, like, we have business coaches too. So it's like, maybe work with a coach, see if you can brainstorm. Is there something that you can add a revenue stream or pivot something to make it more profitable, to get more revenue in the door, to get you out of this cash flow crunch? So we're always here to help with that. Don't just disappear. So that's no small business lender, even the big banks, no small business lender wants to collect that collateral. We want the money back. We want you to repay it. So we're going to do what we can to help you repay it rather than collect the collateral. And that's the other points on here too, like, set up auto pay, or choose a specific payment date, put it in your calendar, be like, I make this payment on the 10th of the month, the 15th, the 20th, whatever that day is, and you're consistent about it, right? Some lenders require that ACH auto withdrawal. Like, I know our lending team, we have those auto payments set up. If you're on a loan with us, we're going to automatically take it out. So make sure you have the money in there, right? If that is creating a different bank account from your operational checking account and making sure you always have the money in there prior to when it is pulled out, like, that's a perfectly fine option. We can do that. And then you set up that date, like, okay, if the auto withdrawal comes out on the 15th, on the 10th of every month, I'm going to make sure that I have that payment in there. Right. And so use your calendar, use your alarms, schedule stuff, and make sure you have that set up. And if you get to this next point, if you get in trouble with a high interest loan, or with like a merchant cash advance that's pulling out too high of a percentage of your sales, you don't have enough cash to cover your other expenses, look at refinancing and seeing if you can get more favorable terms so you have a lower monthly payment, probably over a longer time period, that can help your cash flow to help you stay in business. A lot of businesses that end up closing, especially small businesses, there's certain milestones they track. Year 2 is one of those, because the first 2 years there's such high learning curves, right? The next milestone is year 5. So you learned everything, you pivoted, you're doing what you're doing. Year 5 hits around. If you haven't stayed organized and on top of it, you might end up closing even though you're profitable, but your cash isn't there to cover expenses, right? Maybe you have too much in accounts receivable and you're waiting on payments. And so, you get into this game of robbing Peter to pay Paul, even though you're profitable. And so you end up closing your doors. So understanding your financial cash flow and how that works is really important to staying in business. And refinancing is a part of that to improve your cash flow. And I think I covered the last 2 points already. So
Wonderful, thank you. So if you guys have any more questions, drop them in the chat. But I have kind of just one more question for you, if I can. So oftentimes, new businesses that are small, like very small, maybe 1 or 2 members, they typically try to do their bookkeeping themselves. So if they're going to need any type of funding and they need these different financial statements, how do they create these without a formal bookkeeping system?
yeah, that is a great question. And it happens all the time, especially with small businesses and newer businesses. So, and I'm going to put an additional line in here too. Even if you have a bookkeeping system like QuickBooks, but the data isn't accurate, that puts you in the same ballpark, right? Your financial statements are not going to be, they're not going to tell the right story of your business when you give them to a lender. So there are absolutely ways that you can create these financial reports from scratch. There are templates you can find online, or, you know, Business Impact Northwest has templates. I have helped many people create profit and losses from scratch, balance sheets from scratch, even cash flow statements. Because cash flow is my favorite, because even if you're showing a profit on your P&L, if you don't have the cash flow there, like, you need to know what cash is available, even if it's not from operations. So yeah, all of those things you can build out, and, you know, an Excel template is easy because Excel can do some of the math for you. But there are you can build it in Word. There are other places you can do. I've even seen some people start a financial statement using AI, like ChatGPT. Be careful, anything you put in there becomes public. So I don't know if you want to be putting your own financial information in there, but you can use it to get a template or get the common categories, and then you're filling in your numbers once you pull it off of AI, right? So you just get the document and then you're filling in your own numbers, and you're making sure it is accurate to your business, right? It has your revenue streams, the different categories, not just your top line revenue, like total revenue. Break it down by your sales categories, at least the biggest ones. And so you can track how each category is doing, and then expenses directly related to each of those revenue streams, and then your overhead expenses, and then you're totaling it at the bottom. And there's, you know, your gross profit, your net profit. You can absolutely make them without having a bookkeeping system. It's easier to do it when you have help. So use your coach to get help, or reach out to me. I am always happy to sit in with a coach and help everyone understand the financial statements and how to make the financial statements. And then the balance sheet too. That's the other one we often make from scratch. And that is a little bit harder because you have to think beyond just operational, you know, money coming in and money going out, which is usually pretty easy for a business owner even if you've never written it down before. Like, it's in your head. So we're just getting it out of your head, comparing it with your bank statement to make sure you're thorough. For a balance sheet, though, it goes beyond that. So you're looking at assets, tangible and intangible assets, and the value of those. So if you have equipment, you know, what is the market value of that? And same with all of your liabilities and debts. These things, you know, lining them up, getting them on paper, having the balance there. And then your equity, which for a small business owner, that can be difficult. The balance sheet is just an equation. So at the end of the day, if we're just making the equation balance, like, that's what it is. But going in depth beyond what the loan needs are, I would say, okay, let's figure out your equity and what retained earnings and some of these very accounting specific terms are, to make sure that the balance sheet is actually accurate so you can make decisions off of it, is accurate with your equity so you can make decisions off of it. But yeah, for the purposes of the loan, we do the best we can. And, you know, business decisions beyond the loan, we want to make sure that it's very thorough and we can take the time to fix it if it needs to be fixed.
Wonderful. Thank you so much, Gwen. Do you have anything else to add? Any closing remarks, you know, before we finish up here today?
Yeah, I'm gonna talk about that one thing with real estate specifically. So yeah, SBA loans are awesome for real estate. They require it to be commercial real estate, so not residential, and it has to be owner occupied. So at least whatever the footprint is, at least 51% of that has to be occupied from the owning business, and you're getting revenues from that to repay the loan. You can lease out the rest of the space, that's totally fine, but you can't be dependent on 100% leases. So if you're looking at residential real estate, that's usually not an SBA loan, although sometimes they have different products and there are specifics, and Business Impact Northwest doesn't do residential real estate loans. So More research is required. I know the top level of it, but there are resources out there because residential real estate is a common avenue for small business owners for housing. And so, look and see what's available. And there are places that do specifically those mortgages for property owners, right? Even if,
Yes.
it's not personal property. So,
And that is a very common theme that comes up, especially with our veteran community, is getting funding to buy a residential property and then renting out that property as a landlord. And so one of the other avenues, we often talk about specifically with our veteran community are VA home loans, because those have conditions in them where you can have a certain amount of units in it and still qualify for a VA home loan. So you'd have a few different options there.
yeah.
Well, wonderful.
It's one of those specific examples of a specific loan. So
Yes, absolutely. Well, thank you so much, Gwen, for being here today and sharing all of your knowledge. Oh, we have one more question, if you don't mind.
yeah.
So, can fees for startups be claimed as business expenses such as LinkedIn charges, monthly premiums, the Secretary of State, the IRS, local city licenses, etc.?
Absolutely. You're getting into a question I think that is going to actually relate to your tax liability, though. So you can't claim them as expenses on your taxes unless you have the business license. So as long as you have the business license and you're set up, then yeah, claim them as expenses. If you don't make any revenue, then you'll have a loss for that year, and that's okay. There are laws from the IRS, rules from the IRS around how many years you can claim a loss before they'll start to look at it as a hobby and not a business. So just be aware of all of those. But all of those expenses are standard business expenses once you're established. So just look at your timeline. If you take them all on in November and December, but you don't get the business license until January, you can't you're not going to be filing 2025 taxes for a business because you don't have the license. So just make sure you're aware of that timeline. And there's ways you can do it. So you can self-fund and have a contract with yourself where that's a debt you want to be repaid. Just put it all on paper. The paper trail becomes super important.
Yeah, and I like to say, well, first and foremost, you want to be talking to your tax professional
Yes.
because they're going to have the best information for you. But what you want to think about with these expenses is things like, can this, is this only something I can use for the business, or is this something I can reasonably use in my everyday life? So one of the examples I like to throw out there are uniforms. So if I were to have a blue polo shirt, that could be considered my clothing, right? But if I put my business logo on it, well, now that, that can reasonably only be used for my business.
Yeah, there's all sorts of rules around those
Yeah.
deductions. Yep. That's talk to an accountant, your accountant who knows your business, and you'll get the best advice relevant to you on what you can deduct or not.
Absolutely. Okay. Well, thank you. Well, again, thank you, Gwen, for being here. Thank you all for joining us for today's session. I want to leave you with a couple things here. So whether you're a veteran, military spouse, or supporter of military connected business owners, we appreciate your attendance today. If I leave you with any advice from today, it's to tap into all of the different resources that are out there and available for you. So at Business Impact Northwest, we not only offer business coaching classes and networking events, but our team can also help you to access funding for your business endeavors. I hope you join us for day 3 tomorrow. Jasmine is going to be hosting that webinar, and she's going to be talking a bit about franchising. So we hope to see you guys tomorrow.